Speaking here at the 7th annual INSEAD Private Equity Conference with Nick Bloy. Welcome.
Thank you.
You are the managing partner of Navis Capital Partners, which is a private equity fund mainly or exclusively invested in the Asia-Pacific region. What is your situation update on the state of the private equity market today as you see it?
Well, the industry as a whole is stuck at the moment. There is a very large overhang of undrawn capital commitments, dry powder if you like, but there is a question mark as to how drawable much of that capital is, because the LPs that have made those commitments have got themselves into a sort of cash flow dislocation because they have overestimated the amount of cash inflows they would receive from exits of previous commitments that they've made, and so they don't have the cash flow to fund much of that overhang going forward. But at the same time, there's a question mark about how investable is the money. It may or may not be drawable, but the question is it investable? And I think for a lot of practitioners in the industry, they are finding that their particular strategies that have served them well during the expansionary phase of the recent economic cycle, the bull market phase, if you like, does not serve them at all well in the environment we're in at the moment. And so they're deeply inhibited in putting more capital to work. A couple of examples. Minority investors of any type, whether they're sort of pre-IPO investors, growth capital investors, mezzanine investors. There is a number of segments that sort of make up the minority investor space. But the common issue that they all face is that to get exits, they need the IPO markets to be functioning. They need the public markets to take them out. And the reality is that everywhere in the world, including in Asia, of course, the IPO markets have effectively shut down. And certainly the experience during the last Asian crisis is that when the IPO markets shut down, they shut down for a good 2 or 3 years. And so such investors are sitting on a portfolio of minority positions without any real prospect of being able to get out of them. And of course, as a minority investor, although it's easy to retain a good alignment of your interests with the incumbent controlling shareholder during good times, that alignment can break down in a down cycle, and this is where the real test of that investment style is going to be found. The other type of investor is more control-oriented, typically the leveraged buyout firms who have deployed a lot of capital over the last few years. They are also deeply inhibited right now for a couple of reasons. One is there isn't so much credit available. That's well understood. Leveraged finance teams around the world in the major banks have been fired. Those departments have been shut down, and there really isn't the appetite to fund their sort of investments. And they also have legacy issues, perhaps less so in Europe and the US, where there has been a preponderance of covenant-light debt structures that they're able to enjoy, which gives them breathing room, if you like, over the next 2-3 years. But in Asia, there has only been, to the best of my knowledge, 1 or 2 deals that could be considered covenant-light. So the bulk of the leveraged buyouts in Asia have been, sort of fully covenanted, if you like, and a lot of those are now in trouble with covenant breaches. When you have a covenant breach, you want to hold back some of your uninvested capital to cure the breach. So the last thing you want to be thinking about is actually buying, a brand new business.
Okay, but having said that, from the presentation I saw you give here today, I do get the sense that you're quite optimistic still about the outlook of private equity in Asia, basically for demographic reasons, if I'm to sum up, and the growth prospects of that part of the world, as if, by the way, it was insulated from the rest of the global economy, if I hear what you were saying today, because you still remain, as we saw, quite optimistic. What is your sense there?
Well, Asia is feeling the effects of the global crisis. It's called a global crisis for a good reason. It's affecting every corner of the world. But Asia goes into this crisis in much better shape than any other part of the world. And that's partly a consequence of the last Asian crisis of 10 years ago, which was caused by too much debt, too much unhedged debt. And actually the whole region over the last 10 years has been deleveraging. And there isn't a leverage issue in Asia at the moment. In fact, the banks are very well capitalized. They don't have exposure to any toxic assets in particular. Consumers are not at all indebted. I mean, saving rates have remained very, very high in Asia. And governments have got their accounts substantially in order. So government levels of debt are not particularly high either in Asia. And so although there is an effect in Asia, it's really coming from the reduction in external demand in the US and in Europe. which have been the principal export markets for much of Asia. So one can't say that we're unaffected. What we can say is that the depth of the problem is being felt a bit more acutely in the more trade-oriented economies in Asia. I'd say particularly Japan, Taiwan, Korea, Singapore, Hong Kong. Because they're so trade-led and trade-dependent, they have suffered a very sharp contraction in the last few months. But on the whole and in the aggregate, Asia has seen a sharp reduction in growth, but as a region as a whole has not yet gone negative. And if it does go negative, so what? I mean, it'll be a gentle recession in the aggregate. And the recovery, and this is important because of the fundamentals that I've described, will be relatively straightforward.
One of the things you said in your presentation, which was striking, and you said that we don't have the research yet to back it up, but this is your intuition. I find the intuition interesting, is basically that throughout the business cycle, strategies that were passive have shown that they can't hold up throughout the business cycle, and the only private equity strategies that can hold up through the entire business cycle are active strategies. And you basically had this one sentence where you said, passive is basically leverage beta, active is the alpha of the investment manager. Could you develop that idea? And I think basically that's also your personal investment philosophy as a private equity fund is only active position.
Yeah, let me address the issue of passive investment strategies to start with. There are many, many, many different types of passive investment strategy. And in fact, I suspect that 2/3, 3/4 of the global private equity industry and the capital that it's invested is described by these more passive approaches to value creation. If you're a minority investor of any type, you are essentially backing a company, backing a management team, backing a third party, and you're making an objective judgment about their ability to run their company successfully going forward. You give them the capital.
Or their ability to deleverage the company and then turn that deleveraging into equity.
Well, that's correct. And so when you talk about a leverage buyout, and of course the leverage buyout firms control their portfolio companies, so they have the platform to be active. But the bulk of the value creation comes from this concept that they talk about, which is the pressure of leverage. And that is a passive concept, although it may not feel that passive to the CFO who's got to juggle the deleveraging. The point about those investment approaches is that they will do well in good times. I mean, if you've got beta, positive returns, if you like, during a bull market period, that will get amplified by leverage. If you have an environment of rising multiples, then if you have a minority position, you buy it at a 7x PE as a private company, you list it at a 20x PE 18 months or 2 years later, you don't even have to have changed the earnings, the E, to have made a good return. So timing is all when it comes to passive investment strategies. But of course, these things reverse. And so now on the downside, with the leveraged buyout firms, as you see enterprise values being marked to market, that reduces, that crushes the equity. So the amplification works both on the upside and on the downside. And really, I think one has to judge returns over that full business cycle.
Now, getting to active investment, which is what you do, you said basically that your main focus is growth, growth, growth. That's the only thing you're interested in. You say that it's basically the only part of the world where this can be done is Asia, because private equity stories in the US and Europe right now at least are about cost cutting, scaling down, trying to pull in cash by any means possible or save cash. But in Asia, you're much more excited about the growth prospects as an active investor.
Yeah. I mean, when we talk about active ownership, what's the goal of that active ownership? And economically, the goal is to essentially improve as sharply as you can the free cash flow generation model of a business between the time that you buy it and the time that you come to sell it. And there are only 3 levers that will drive an improvement in unlevered free cash flow. It is growing revenues, growing the top line. It is expanding margins. And it is making your businesses more asset efficient. So all 3 of them are important components or levers, if you like, to driving intrinsic value creation. But the most important in Asia and the most readily accessible is growth, because these economies are growing fast. And there are hundreds of millions, if not billions, of consumers, young consumers. These are very young populations, growing fast, rising disposable incomes. They are transitioning from having to consume staples, if you will, to brands. And if you have brands, or if you own a brand or you can develop a brand, that is a very attractive dynamic to take advantage of.
Which means that when you're looking at hiring, maybe say a young INSEAD graduate who wants to go into private equity, today you're not looking at those investment banking profiles anymore. You said explicitly in front of the students today that those weren't the CVs you were looking at. You're looking at people who are coming from management consulting, restructurings, change management. These are the profiles that have a great future in private equity today?
I think so. I didn't mean to denigrate the investment banking profession. Although
it's not about valuation, is what you're saying. It's about
well, it's not about capital
change.
structuring. I mean, of course, capital structuring, in certain environments, you can make money by being smart at capital structuring, but it's not really the core. It's not really intrinsic. And so what we look for in professionals is the ability to lead, well, identify change. What is a value creation thesis with this company in this industry? How can we make it twice or three times as big? How can we double its margins? So we're looking for strategic insight, first of all. And then we're looking for the ability for that insight then to be transmitted from Navis and our team of professionals into the portfolio company. And that requires change management skills. And it requires some sort of authority, if you like, beyond just being the controlling shareholder. It requires some industry knowledge, some real expertise. Done it before, I'm credible, I can do it again. And really that's what we're looking for. And those, the skills that, the industries which provide those skills are very much management consulting, in my opinion, as well as, specific industry or functional areas of expertise.
That's looking forward into the industry. Another thing, and this will be our last words before we part, you say that one of the transformations that's going to happen after this crisis is over is removal of all of the intermediaries that kind of blossomed in the boom years, and reduction of the fees, which, by the way, would be bad news for you.
Yes. I don't think there'll be a total elimination, but there is going to be a contraction. I think the people who really count in this business, I mean, there's two ends of the equation. There's guys who do the deals, like Navis, and there are the guys who have the money, typically the big pension plans, life insurance companies, and so on. And we detect from those investors a frustration with the layers of intermediation that strip away the returns that we generate in a deal, what they actually receive as the ultimate investor. There's just too much intermediation and leakage.
Examples of which being advisory companies.
Well, a fund of funds, for example. Of course, we're charging a management fee and a carried interest. Some fund of funds obviously invest in Navis, and those fund of funds, some of them are very good, by the way, I hasten to add, but they typically will charge another management fee and also some carried interest. So there is a drag on a gross return down at a portfolio company level. Let's say we make a 40% IRR on a deal that we've generated. Now, by the time we transmit that up to our investors, we've taken our fees and carry, so it may net down to a 30% IRR. Then if it's a fund of fund who is the next,
Same thing
in the next chain,
again. Yep.
They take it, and now it's netted down to a 22% IRR. And I think that ultimate investors are frustrated by this leakage, if you like.
Okay, so that's one of the things that's going to happen on the intermediary side. But what about the fees?
Okay, the fee issue. The fee issue is, and now the boot is on the foot of the investors, so that they can start to dict terms a little bit more aggressively. The reality is that the contract at the heart of private equity is one between an investor and the management company, and it is about a long-term risk-sharing arrangement, whereby if we make a good investment and we come to exit in 5 years' time, we'll make a good profit and we'll take a share of it. And that's really the core of the business. That's how the business is aligned. The GP and the LP is aligned over medium to long-term value creation. What distorts that alignment and relationship is when management fees lead to large, even excessive profits at the management company. And so professionals in the management company may be very happy living on the dividends that they get and their high salaries and bonuses each year from management fees. And if that incentivizes them more than the medium to long term, it seems like a misalignment. To me, to investors, I think to any kind of objective industry observer.
Nick Bloy, thank you very much.
A great pleasure. Thank you for having me.